Welcome back friends to the class number 83. In the previous video we have covered in detail about the machinery term loan. Now we will start with building term loan. So again, building term loan is your capital expenditure. It appears as fixed asset in your books of account, whatever building that you have constructed using that building term loan. So the end use of this loan is always the construction of a building. You want to construct the building for your business, not your residential building. You want to construct the building for your business. So for that, building term loan is given to you. So for construction of a residential properties building, then you take the housing loan from the bank, so not the building term loan. Building term loan is always for your business only. So it has monthly EMI repayments. You have to deposit the EMI every month. So generally the building term loan is given to you for 7 years period. It can go up to 10 years as well. It all depends upon the different policies and internal regulations of bank to bank. So this 7-year periods include the moratorium period as well. In the previous video, I have explained the whole concept of moratorium to you. I will just brief it again to you. The moratorium is when you ask the bankers to allow you some time for relaxation for payment of principal amount. So the moratorium can be for interest and can be for both principal and interest. When the moratorium is of only interest, the moratorium is only of interest, which means the banks will take monthly interest payments from you and you will pay the principal amount after a certain period of time as agreed with the bankers. When moratorium is of both principal and interest, that it would mean that you will not pay anything to the bankers for certain agreed period of time, and after the end of that agreed period, you will start repaying both principal and interest. The moratorium of principal and interest is very rarely given, and moratorium of principal which means repayment of monthly interest, is the most common type of moratorium which is allowed by the most of the bankers, right? So the general period of moratorium can vary from 6 months to 12 months. It can be lower than 6 months also. Generally, it is allowed for 6 months, which would mean that for 6 months period, you would only pay the interest, and after the end of these 6 months, you will start repaying the principal amounts as well. So when I say that 7 years include the moratorium, so it would mean that 7 years into 12, 84 months is your total repayment period. And if you have taken 6 months moratorium for payment of principal, that would mean the 6 months will be deducted from here, because that 7 years always include the moratorium period. So you are left with balance 78 months. So you have to pay off all the principal amount now in 78 months period, right? So what is the security in building term loan? The charge over the land and building, primary charge, exclusive charge on the land and building for which you are taking that building term loan is taken by the bankers. Many people are confused about it. Some people, while taking building term loan, says that we will offer any other property as a collateral security to you. We will not offer the property for which we are taking the building term loan. No, that is not allowed. You have to give the charge over the property for which you are taking the building term loan. So there is no need of any secondary collateral, any collateral security, because you have already taken the charge over the land and building, and it serves as your primary security and both collateral security. So moratorium period, as I have already mentioned, it is allowed for 6 months or 12 months period, right? Margin of 25% is taken, which would mean if you have taken a loan, if your building construction cost is 10 lakh rupees, you want to incur the total expense of 10 lakh rupees on building construction, the banks will give loan of 7.5 lakhs and 2.5 lakh worth of amount you need to introduce from your own personal sources. That would be your margin. 25% is general minimum margin that is taken by the bankers in building term loan. So another distinction between the machinery term loan and building term loan is the treatment of GST. In machinery term loan, usually the GST that you pay on purchase of machinery is not financed by the bankers. You have to pay that GST from your own pocket only. That is again subject to internal policies. But in building term loan, the GST on construction is included in the total construction costs, because the input tax credit of that GST is not available as per the GST laws. That is why the total cost of building for which you need financing will include the GST amount as well. So again, the assessment of this loan is done basis the debt service coverage ratio DSCR only. Like machinery term loan, the disbursement of building term loan is done to the material supplier. Suppose you are buying some sands, some bricks from any supplier for construction of building. So the banks, you will give the invoice to the bankers. The banks will then deposit the amount proportionately, of 75% amount proportionately to your supplier's account. So this is the most preferred method used by the bankers of disbursing the building term loan. Alternatively, you can take the reimbursement of already incurred expenses out of your pocket, like machinery term loan. Suppose you say to the banker that I have constructed the building 3 months back by incurring the total 10 lakh rupees expenditure out of my own pocket, and you submit the CA certificate for that, you submit the invoices, you submit the proof from bank statement that you have actually done the payment to those suppliers, you submit the building ledgers. So after satisfying with all these documents, bank will make sure that you have actually constructed that building, and at that too with your own pocket, on from your own pocket, without taking any finance from any banks or NBFCs. After satisfying with that, the banks will give you 75% amount of the expense that you have incurred in your account. The amount will be released in your limit account or current account directly by the bankers, right? So you can refinance. We call it refinancing of already paid off bills. So you can refinance only last 6 or 12 months, generally last 6 months, or some banks allow 12 months also, up to last 12 months bills that you have paid off out of your own pocket, not older than 12 months, right? So what are the key underwriting points in this building term loan? Before sanction, before going ahead with building term loan, the borrower need to submit the architect estimate, the stamped and signed architect estimate of proper total cost of the construction of the building that you will incur, right? The architect will submit the proper bifurcation on how much expenses will be incurred on sand, on bricks, and everything will be covered in the architect estimate, floor by floor, how many floors will be created, everything will be covered, and proper cost structure should be given by the architect. That estimate you need to submit to the bankers, or as a banker you need to take this from the client. Then the building that you are constructing must be according to the bylaws of the locality where the building is situated, and approved map from municipal corporation or whatever the governing authority there is. The approved map of the building is also required. Bank will not fund any illegal constructions, that you always understand. The banks will fund only the legal constructions as per the bylaws of the locality. So the approved map of the building in line with the architect estimate of projected cost should be submitted to the banks before disbursement of building term loan. So as a credit underwriter, you need to have clear understanding on why this additional construction is required for the building, why client is constructing additional building, what benefit will it add to the business. You need to be aware of all these points. So original bills of suppliers will be kept by the banks because the banks have primary charge on the building. So the estimated cost submitted by the architect is used to decide the sanction amount. Bank will study that architect estimate and bank will decide the sanction amount accordingly basis your eligibility. And the building must appear in the books of account. Suppose you have submitted the architect estimate of rupees 1 crore and you are asking for 75 lakh rupees term loan, building term loan from the banker, as 25 lakh rupees shall be your promoter margin, 25%. So you are asking 75 lakh rupees term loan from the bankers. You have submitted the architect estimate of 1 crore. It would mean that 1 crore rupees building should appear in the books of account. You cannot say that I have constructed 50% of the building out of my books. You need to take full tax invoices of all these 1 crore rupees amount in the name of your firm, and that building should appear in the books of account because the loan is given in the firm names only. So time to time, as and when bank release each tranche of your loan, the bank will ask for CA certificate of end use and margin. It will be taken at the time of disbursement of each tranche. Some banks stipulate the condition of quarterly visit of technical engineer, which is internal in their bank. which will go and visit the site, which will verify that building is actually getting constructed. The building term loans funds are not diverted. There is actually construction going on at that place, and the construction is as per the architect estimate, as per the approved plan. So all these vetting will be done by the technical engineer or the valuer, which can be internal or external to the bankers. So some banks makes the disbursement linked with the technical team's confirmations only. That technical engineers in some banks have policy that this technical engineer will go to the site and will confirm that how much percentage building has been completed, and bank will, according to that completion percentage, will release the proportionate amount to your account. So some banks like machinery term loan stipulate the DSRA condition as well. DSRA is debt service reserve account, which would mean that if, for example, 6 months worth of EMI, the bank will keep that with them as FD, as a security. In case you default on EMIs, the banks will use that FD to liquidate the funds and to repay the EMIs. So this is about the building term loan, and in the next video we will be studying about the working capital term loan. Stay tuned with this channel. Thank you very much.